Welcome to the deep dive. Today we're zeroing in on Realty Income's first quarter of 2025.
Yeah, diving into the monthly dividend company.
Exactly. We've got their earnings call presentation, the transcript from Seeking Alpha, and, some analyst insights as well.
Right.
All aimed at giving you a clear picture of how this, major real estate player is doing and where they might be headed.
Definitely. And if you're keen to get a quick grip on financial markets, especially real estate trends, this should be really useful.
That's the plan. Our mission here is to pull out the crucial insights of their performance, especially those European moves everyone's talking about, their financial health, the outlook.
But without getting totally swamped in the details.
Precisely. Keep it focused.
And what really jumps out right across all the materials is this consistent story of, well, strength and pretty clear strategic execution. Q1 really seems to highlight that.
Absolutely. Okay, so let's unpack that Q1 performance then. The headline numbers look pretty robust.
They do.
AFFO per share came in at $1.06. That's what, a 2.9% increase from last year?
Yeah, keeps that steady growth trend going.
Seems like it. And get this, their total operational return for the quarter was 8.9%. That feels significant. What's driving that number?
Well, that 8.9% is a key metric, It basically combines their AFFO growth. Think of that as the cash flow for shareholders after the important stuff.
Right.
And their dividend yield. So it really gives you the total return picture for investors.
Gotcha, the full package. And they were clearly active investing-wise, $1.4 billion put into properties.
That's a lot of capital deployed.
Yeah, and what really jumped out at me was where it went. So $479 million in the U.S., okay, but a much bigger slice, $893 million in Europe. That means Europe was, like 65% of their total investment this quarter?
Exactly. That's a big signal.
And the initial cash yields were interesting, too. 8.3% here in the U.S., but 7.0% over in Europe. Why the difference there, do you think?
Well, that allocation, it really underscores this major strategic push into Europe. The slightly lower initial yield there, it could reflect a couple of things. Maybe they see less long-term risk in those specific European assets, or perhaps more likely, it signals they see more potential for, bigger rent growth down the line, adjusting those rents up to market rates.
Ah, okay. So a bit of a trade-off, maybe. Immediate yield versus that future potential.
Maybe.
Speaking of their properties, occupancy looks solid, 98.5%.
Still very high.
Just a hair below the last quarter, apparently, but still above their historical average.
Right.
And here's a figure that sounds really positive. Rent recapture rate of 103.9% across almost 200 leases, and 92% were renewals. What does a rate over 100% actually tell us?
Yeah, that's a strong indicator. A recapture rate over 100% means they're successfully renewing leases, often, getting higher rent than before.
Okay.
And the fact that most are renewals. It suggests tenants are happy, the locations are good, they've got strong relationships.
Makes sense. They were also actively managing the portfolio, selling off some properties. 55 of them brought in $93 million net, and interestingly, $63 million of that was from selling vacant properties. Seems like smart housekeeping.
Exactly. Selling off vacant spots is pretty standard and sensible for REITs. It cleans things up, simplifies operations.
Frees up cash.
Frees up capital, yeah, that they can then put back into new deals, maybe ones with higher potential returns.
Okay. So a solid quarter overall, it sounds like. But yeah, it really feels like the main story here is this increasing focus on Europe.
It does seem to be the big strategic theme right now.
What's driving that? Why the big push there?
Well, the reasoning they laid out, both in the presentation and the call, it's pretty compelling, actually. They're specifically targeting retail parks.
Right. I saw that UK and Ireland mainly.
Primarily UK and Ireland for now, yeah. Their analysis suggests current rents in a lot of these places are, well, below market. And importantly, they also pointed out that the cost to actually buy these parks is less than building new ones from scratch.
Below market rents and cheaper than building new.
Yeah.
Yeah, that definitely sounds like a smart play.
It's an attractive value proposition. Plus, they mentioned opportunities to improve these places, reposition them, attract major retailers. They specifically name-dropped Lidl.
Lidl, right. How important is getting a big name like that to anchor a retail park?
Oh, it's huge.
Yeah.
Attracting a strong anchor like Lidl, it creates a massive draw, brings in shoppers, makes other retailers want to be there.
Increases the buzz.
Exactly. Increases desirability, stability, and ultimately lets them push for stronger rents down the line. And, like you touched on, they see real potential for future rent adjustments, that mark-to-market opportunity.
Right.
They estimate current rents could be, 5-6% below what the market's actually charging right now.
So there's built-in potential for rent growth just by catching up.
Potentially, yes.
And it sounds like this retail park strategy is already showing some positive signs. They mentioned cap rate compression since they started investing there a few years back. For our listeners, what does cap rate compression mean in this context? Why is that good?
Right. So cap rate compression basically means the market is viewing these assets as less risky than before.
Okay.
Investors are willing to accept a lower initial return, which generally pushes the actual market value of those properties up.
Got it. So values are increasing.
Seems that way. They also noted really low vacancy in these European
Yeah.
parks, like 1-2%.
Wow.
And encouragingly, when they do fill those odd vacancies, they're getting positive rent bumps. I think it was 7% on backfills in Q1.
A 7% increase on refilling empty spots? Yeah, that's a good sign.
Yeah.
And it doesn't sound like they're stopping with the UK and Ireland either.
No. They hinted at further expansion. Poland was specifically mentioned as, a
Yeah.
potential next target.
Poland. Why Poland? What's the attraction there?
Well, Poland seemed to offer this compelling mix. You've got a growing economy, which obviously helps retail,
Sports spending.
right? And you've also got a relatively stable geopolitical position within Europe, especially being a NATO member. That makes it look pretty attractive for long-term real estate investment.
Okay, interesting. Now, while Europe's clearly a big focus, they're definitely still active back in the U.S. market, right?
Oh, absolutely.
Yeah.
They mentioned looking at a huge amount of potential deals stateside, something like $22 billion worth just in Q1.
$22 billion sourced. Wow.
Yeah, massive pipeline. But, and this is key, they're being really selective. They specifically talked about being cautious about downside risks, tail risks with some of the higher yielding stuff here.
So seeing tons of opportunities, but really picking their spots carefully, only moving if the risk versus reward lines up just right.
Pretty much. They explicitly said they pass on deals where that risk-adjusted return just wasn't compelling enough for them. And that really highlights, a commitment to disciplined underwriting. They seem focused on the quality of the deal, sustainable long-term value, rather than just, say, chasing the absolute highest initial yield, which might carry extra baggage.
Right. Prioritizing stability. Makes sense. Okay, let's shift gears and talk financials. How solid is their footing there? Balance sheet health.
Yeah, it looks pretty strong. They successfully issued $600 million in 10-year bonds, unsecured,
At what rate?
5.34%, which, in the current environment is a pretty reasonable cost for borrowing long-term money.
Okay.
They also expanded their big credit facility, the multi-currency one, up to $5.38 billion. Gives them a lot of flexibility.
So good access to capital, it sounds like. What about their actual debt levels, leverage, ability to cover payments?
It's comfortable. Their main leverage metric, net debt to that adjusted EBITDA number, is at 5.4 times, which is generally seen as quite manageable.
And coverage.
Their fixed charge coverage ratio, basically, can they cover all their fixed payments? Like interest is also healthy at 4.7 times.
Okay.
Plus, they reported strong liquidity, about $3.1 billion available, and their upcoming debt maturities through 2026 look pretty manageable, too.
So financially, yeah, seems like they're well set up to keep pursuing these strategies. What are they saying about the rest of 2025 then? The outlook.
They reaffirmed their main guidance. So that AFFO per share for the full year, they're still expecting it between $4.22 and $4.28.
Okay, no change there.
And they're sticking with your expectation for total investment volume for the year, too, around $4.0 billion.
Right.
They also repeated their expectation for about 75 basis points, or 0.75% of potential rent loss, mainly from kind of integrating previous acquisitions.
Okay, that was already factored in. And they even hinted they might deploy more capital, invest more if good opportunities pop up, especially if their cost of capital gets better.
Exactly.
How does a lower cost of capital give them that extra flexibility?
Well, basically, if it costs them less to borrow money or raise equity, it means they can make deals work financially that maybe wouldn't have penciled out before. It widens the range of opportunities they could pursue while still hitting their target profit margins that spread between the yield they get on an investment and what it costs them to fund it.
Got it. Makes the math work on more deals. Now, they also talked about some new initiatives that sounded pretty interesting. This U.S. Core Plus Fund. What's the story there?
Yeah, this is a significant move. It's their step into the private capital world. They're basically setting up an investment fund to offer to big institutional investors, think pension funds, endowments, that sort of thing.
Okay.
And they said they're already seeing positive early interest. The goal here, it seems, is to create another source of capital besides the public markets,
Right.
which could, down the road, lead to a more asset-light model for their public shareholders, because they can earn fees managing this private money without always having to issue new stock to fund every single acquisition.
Huh. So managing funds for others, earning fees, less reliance on public equity raises. Yeah, that could be a pretty big evolution for them.
It could be. And the other new thing was this opportunistic loan they made in the data center space.
Yeah, that caught my eye. A bit different from their usual retail and industrial focus, isn't it?
It is, yeah, a bit of a departure. It was a loan to a private developer who's building a data center in Virginia.
Okay.
But the really notable part is who the tenant is going to be. Apparently, it's a major client with a high investment grade rating.
Ah, so a very solid end user.
Exactly. And the structure of the deal, they suggested, could potentially give Realty Income the option to actually acquire these data center assets themselves later on.
Interesting. So kind of dipping their toe into a hot sector, data centers potentially leading to ownership, all backed by a strong tenant.
Seems like a strategic way to explore that space, yeah.
Okay, finally, let's touch on their current tenants, the existing portfolio. How's the health there? How are they holding up?
Overall, the picture seems very healthy. They highlighted that over a third, 34%, of their client base is investment grade rated.
That's a good chunk.
It is. And on average, across the portfolio, tenant rent coverage, basically, their ability to pay the rent out of their earnings, is a solid 2.9 times.
Pretty comfortable cushion.
Yeah. And maybe most importantly, especially for the retail side, over 90% of the rent comes from businesses that are considered, non-discretionary.
Like grocery stores, pharmacies.
Exactly. Or low price point retailers or service-oriented businesses, the kinds of places people still go even when money's tight.
Right, more resilient. That fits their long-term strategy, focusing on those stable tenants. They even gave an update on Zip's car wash, right?
They did.
Well-
Actually, the 100% of those Zips assets were renewed. The overall rent recapture was 94.3%.
Okay, so slightly below 100% overall there.
Yeah, which indicates there were some rent adjustments downwards on,
Yeah.
on some of those locations as part of the negotiation.
Yeah.
But they framed it as getting better terms overall, like higher built-in rent increases down the road and longer lease terms. So maybe a slight near-term rent dip on some, but better long-term value and stability.
Ah, okay. So a strategic negotiation.
Seems like it. That Zips example kind of illustrates their proactive approach to lease management,
Right.
working with tenants but still protecting that long-term value. And it feeds into their track record. Their historical credit loss, tenants not paying rent, has been remarkably low, averaging only about 0.4% of their total rent since 2014.
Wow, less than 0.5% historically. Yeah, that really speaks to the quality they focus on.
It does. It says a lot about their underwriting and tenant selection.
Okay, so to kind of wrap this up then, Realty Income, strong start to 2025. Clear strategic focus on growing in Europe, especially those retail parks, while still being, cautious but active back here in the U.S. Financials look robust.
Yeah, solid balance sheet, good liquidity.
And they're exploring these interesting new avenues for growth with the private capital fund and that data center loan.
Absolutely. What stands out is, well, particularly interesting to me, is that significant potential upside in Europe from marking those retail park rents to market.
Right, that built-in growth.
That could be a really substantial driver for them going forward.
Yeah.
And yeah, that move into private capital is definitely a noteworthy evolution for a public REIT like them.
Totally agree. It gives us, and hopefully you listening, a really valuable insight into how a major real estate player is navigating, the current economic climate, finding growth, managing risk. Definitely relevant stuff if you're tracking markets or real estate.
Which leads to maybe a final question for you to think about. How might Realty Income's apparent success, especially with this European retail park model, influence what other real estate companies decide to do?
Good question. Will others follow?
Possibly. And what are the potential long-term ripple effects of big players like them moving more seriously into private capital? How does that change the landscape for publicly traded REITs overall? Certainly something to mull over.
Definitely food for thought. Thanks for taking this deep dive with us today. We'll catch you on the next one.